Every few months, the same headline runs across every major outlet in Australia. The economy grew. GDP is up. Quarterly growth beats forecasts. It looks like good news, and it gets reported like good news. Here's the detail almost nobody follows up on. For several of the quarters where that headline ran, the average Australian was individually getting measurably poorer at the exact same time. So here's the question worth asking. How does an entire economy grow while the people inside it are going backwards? The answer is documented in the same statistical release that produces the celebratory headline. Just one line further down in the number nobody puts in the headline. Here is what we found. GDP measures total output across the entire country. It does not measure how that output is shared, and it does not adjust for how many people are splitting it. Two completely different things can be true in the same quarter. Total output rises, and the average amount available per person falls. If the population is growing faster than the economy is. In multiple quarters across 2023 and 2024, the Australian Bureau of Statistics recorded exactly that. GDP rose, while GDP per capita, output divided by population, fell for several consecutive quarters in a row. Economists have a specific term for this condition. It is called a per capita recession, and Australia was documented as being in one while the headline above it read, "Economy grows." If the total economy was growing while the average person was shrinking, where exactly did the difference go? And who was it going to? To find where it went, the economy needs to be split into the two things it's actually made of. Who owns the income and who owns the assets and capital generating it. National accounts data tracks this split directly. It's called the income share of GDP, divided between labour, which is wages, and capital, which is profits and returns to business owners and shareholders. For most of the post-war period, that split moved in a relatively stable band. Since the early 2000s, and especially since 2020, the labour share, the portion of national income going to wages, has trended towards some of the lowest levels recorded, while the profit share has pushed towards some of the highest levels on record, driven heavily by mining and resource export earnings during the commodity price surges of the last several years. This is not a one-quarter anomaly. The shift has been visible across multiple full business cycles, through periods of both low and high unemployment, through mining booms and mining slowdowns, through coalition and Labor governments alike, which is itself informative, because a structural condition that persists regardless of which party is in office is a stronger signal of an underlying mechanism than a policy choice tied to one administration. Here's the number that should reframe every "the economy is growing" headline you read from now on. When the Australian Bureau of Statistics splits GDP between wages and profits, the wage share of national income has been sitting near multi-decade lows, while the profit share has been sitting near record highs. In the same economy, in the same quarters, reported by the same agency. The economy isn't failing to grow. It's growing in a specific direction, toward capital, and away from the people doing the work that generates it. We call this the wage share floor, the structural tendency for the labour portion of national income to compress toward a floor while the capital portion expands, even during periods of strong headline economic growth. Once you know what to look for, you will find it in every record profits earnings season that lands in the same month as wage growth disappoints inflation data, in every productivity report that shows output rising faster than pay, and in every politician's GDP press conference that never once mentions the income share split underneath the number. GDP going up tells you the size of the pie grew. The wage share floor tells you who actually got the bigger slice. And for most of the last 2 decades, it hasn't been the people baking it. If wages are losing share while profits gain it, that has to be a choice made somewhere by someone. So who is actually making that choice, and why? This is not market forces drifting on their own. It is, in significant part, the documented, stated objective of monetary policy. The Reserve Bank of Australia's core mandate is to control inflation, and its primary tool is the cash rate, set explicitly to slow demand in the economy, including specifically wage demand. In multiple public statements through 2022 and 2023, RBA officials explicitly stated a goal of preventing a wage price spiral, language that, in practice, means keeping wage growth below the rate businesses are raising prices, on the stated theory that wages chasing prices would make inflation worse. Between 2022 and 2023, the RBA raised the cash rate at the fastest pace in the modern history of the bank, citing inflation control as the justification each time. In board minutes and public commentary released across that period, wage growth was repeatedly named as a specific risk factor the bank was watching closely. Not because wages had outpaced inflation, but because the bank was concerned they might begin to. At no point in the same documented record did the RBA name corporate profit margins as an equivalent risk factor requiring an equivalent policy response. Here's the part of the inflation story most coverage leaves out entirely. While the Reserve Bank was explicitly working to keep wage growth contained to avoid a wage price spiral, corporate profit margins in the same period were sitting at multi-decade highs, and the ACCC and several Treasury Commission reviews specifically examined whether businesses were using inflation as cover to expand margins beyond what rising costs justified, a pattern some economists call greedflation. Wage growth was the side of the equation policymakers were explicitly trying to suppress. Profit growth was not held to the same explicit target. That asymmetry is the policy itself, not a side effect of it. We call this the output illusion. The gap between an economy whose total size is rising and a population whose individual share of that size is falling, obscured specifically because the headline statistic, GDP, was never designed to report the difference. Once you see it, you will find it in every population-driven growth figure that gets reported without its per capita twin, in every soft landing narrative that never mentions whose income actually absorbed the landing, and in every wages policy debate that treats wage restraint as a technical necessity rather than a documented, deliberate choice about who bears the cost of controlling inflation. The wage share floor explains where the money went. The output illusion explains why most people never noticed it happening, because the number put on the news was never the number that measured it. If the gap between the economy grew and I'm not better off has been quietly bothering you for a while, stay with it, because the next part puts an exact figure on what that gap has cost. Here is what this costs a typical Australian household, calculated specifically. If wages had simply kept pace with productivity growth over the past 2 decades, the same rate at which output per worker increased, average annual earnings today would be measurably higher than they actually are. Multiple Australian economic research bodies have modelled this gap in the tens of thousands of dollars per worker, accumulated across a working life. This is not a marginal rounding error in the calculation. The productivity wage gap compounds the same way an investment return compounds. Except in this case, the compounding works against the worker rather than for them. Every year the gap persists. The base from which the next year's comparison starts shifts further away from where it would have been, had wages tracked productivity from the outset, which is part of why economists studying this gap consistently describe it as a structural feature of the wage setting system, rather than a temporary lag that will self-correct once the economy normalizes. That is not money that disappeared. It is money that was generated by the exact same workers, in the exact same economy, and recorded in the exact same GDP figure that got celebrated in the headline. It simply settled into the profit share of national income instead of the wage share. You can see a version of this gap on your own payslip. Take your current wage growth over the last few years and compare it to inflation, plus the headline GDP growth rate reported in the same period. For most Australian workers, that comparison shows a wage trend running below both, meaning the workers' slice of an economy that grew by the official measure is mathematically smaller today than it was at the start of the comparison, even before accounting for population dilution from the output illusion. Run this comparison on your own payslip right now. Take your wage growth over the last 3 years and compare it to the headline GDP growth reported by the government over the same 3 years. For most Australian workers, wages grew slower than the economy did, which means that by the government's own official measure, your personal share of an economy that got bigger actually got smaller. That isn't a feeling. It's arithmetic, using numbers the same agency that publishes the celebratory headline also publishes, 2 tables further down in the same spreadsheet. This is why the economy is strong and I can't get ahead can both be true at once. Reported by the same government in the same week. They are not contradictory headlines. They are 2 different measurements of the same system, and only one of them gets read out loud at the press conference. This mechanism does not operate in isolation from the family income and housing pressures already documented elsewhere in this series. There is a second layer sitting directly underneath the wage share squeeze. The way superannuation, taxed and invested at the moment wages are paid, locks a portion of even the shrinking wage share into markets that disproportionately benefit those who already hold capital. The next investigation runs that exact calculation. So if the growth is real and the missing money is real, and it's all recorded in the same official data, why does the public conversation keep treating this as a mystery? None of this is hidden. The Australian Bureau of Statistics publishes the wage share and profit share of GDP in the same national accounts release that produces the headline growth figure. The Reserve Bank's wage price spiral statements are matters of public record, delivered in speeches and board minutes. The ACCC's margin reviews are published documents. None of these are obscure documents buried in archives. The National Accounts Release is published quarterly, on a fixed schedule, available free on the ABS website the same day the GDP headline goes out. The Reserve Bank's board minutes are released on a set lag after every meeting. Also free, also public. Anyone with an internet connection can open both, scroll to the income share table, and see the same trend described in this investigation, which is itself part of the point. The barrier here was never access. It was attention. The mechanism survives not because the data is secret, but because GDP grew fits in a headline, and the wage share of that growth fell to a multi-decade low, while the profit share hit a record high does not. This pattern is not unique to Australia, but the specific combination, a resource export economy with rapid population growth, a central bank explicitly targeting wage restraint, and a tax and superannuation system that channels a share of even depressed wages back into capital markets, produces a more concentrated version of the same global story than most comparable economies show in their own national accounts. An economy can grow in total and shrink for the individual at the exact same time, in the exact same official release, measured by the exact same statistical agency. Once that distinction is visible, the economy is doing well, stops being a single fact, and becomes a question. Well, for whom? Measured by which number? The headline was never lying. It was just never required to tell you which part of the economy it was describing. And for most of the last 2 decades, it wasn't describing your part. What you have seen today is the income share mechanism underneath every economy grows headline. The documented gap between total output and individual outcome that the GDP figure was never built to report. It does not operate alone. Subscribe so the next investigation reaches you before the next national accounts release, when the same split between wage share and profit share will be published again, in the same quiet line beneath the headline nobody reads out loud.